The bond sell-off intensifying in today's action. Taking a look at yields shooting to the upside. You've got the 10-year right around 4.65. You've actually got the 2-year just shy of that 5% level. Now, the move higher in yields coming as investors continue to push out their bets on rate cut timing, expecting maybe we're not going to see the Fed cut clearly as early as June. Now there's talk about we might not even see a rate cut before the end of the year. Here to break it all down is Michael Contopoulos. He is director of fixed income at Richard Bernstein Advisors. Michael, it's great to have you here. So talk to us just about your reaction in this spike higher that we've seen in yields with the 2-year just below that 5% level.
Yeah, this isn't really surprising to us. When we came into 2024, one of the big themes at RBA was that we were going to see higher rates rather than lower rates, that the market was quite frankly being absolutely ridiculous in pricing in 6 cuts for the year. We couldn't believe that back then they were pricing in a cut for March. I mean, growth is quite strong in the US. When you look at most of the economic indicators out there, they bottomed roughly a year ago, whether that be leading economic indicators, PMIs, durable goods orders, industrial production. You look at market-based measures like credit spreads, copper, they're all sort of breaking out, or in the case of spreads, breaking lower. You look at lending standards, they've loosened. I mean, there's really zero reason for the Fed to hike from a cut from a growth perspective. And then you throw on inflation, and it's a whole nother ball of wax. And there's just really, in our view, very little chance that they're going to be cutting anytime soon. And the market will probably have to price in a hike at some point again.
When would you anticipate that, Michael?
Well, I think it's going to take a little bit of time before investors fully recognize that eventuality. My guess is once you get past, June or July and you start overlapping the lows in inflation, which really were on a year-over-year basis in June of last year, I think you're going to see the market start to say, wow, inflation is not slayed. We're not going back down to 2%. Economic growth is actually accelerating. Housing prices are going up, which have a direct effect on owner's equivalent rent, OER. OER is about a third of CPI, and that was supposed to be the driver to bring us lower inflation and more towards the 2% mandate this year. And in fact, what it's going to end up being is going to be a headwind to inflation as home prices are actually going back up. OER is also going up. And so I think you're going to really start to feel that pretty much from now through the summer. And again, as you start to overlap the lows on a year-over-year basis come June and July, you could easily see 3.5% or high 3% inflation again. We're not talking, 5, 6, or 7% inflation, but you could be talking mid threes, and that's nowhere close to 2. And I think at that point, investors are going to have to start thinking about tighter policy rather than easier policy.
Michael, talk to me just about the odds of this happening. When you weigh the next move here from the Fed potentially being a rate hike, how much more likely do you see that rather than their next move being a rate cut?
Well, I put the odds as not so much that I think they will hike as much as I think that, the market will start to price in some probability of a hike, which is meaningful from a market perspective, both from a credit perspective as well as from an equity perspective. Whether or not they actually get to that point is a different story. But I do think, and you already saw it last week or 2 weeks ago, several Fed officials out there talking about no cut in 2024, and that if the data continues to show an increase in inflation, that they may have to start thinking about tightening policy again. So sometimes just the act of talking about it can do the Fed's work for themselves. So, maybe it's a 20% chance it's a hike. Maybe it's a 50% chance of a hike. I don't know if that's necessarily the right question to be asking, because the process of getting to the point where it's even considered is what's important and what will start to move markets.
Yeah, Michael, with that in mind, then I guess when we talk about the move higher that we could potentially see in the 10-year yield, how much higher do you see that potentially going as the market does maybe begin to price in what could eventually be or could potentially be a risk here for the market when we talk about the fact that the Fed might not be cutting now for quite some time?
Yeah, well, I mean, listen, I think, you can definitely see 5% before you see 4%. I think that's sort of a foregone conclusion at this point, given we're at 4.6%. So maybe that's not so novel of a statement anymore. Could you get higher than that? You absolutely could get higher than 5%, particularly when you start to think about global factors, coming from Japan, for example, if you get a spike in oil prices, if you get supply concerns again with respect to Treasury issuance, there's a lot of exogenous factors that could affect interest rates to the upside, in addition to a lot of the fundamental factors on inflation and growth that we just spoke about. So I easily see 5%, before we see 4%, as I mentioned. And would it surprise me if we got to 5.25 or 5.5? It wouldn't. The one other thing I'll just note is that depending on how fast this happens, it's either, it might not be great for the S&P at a market level, but that underlying growth is actually quite bullish from a big part of the market. Industrials, energy, materials, even small caps, if their earnings growth outstrips the move in interest rates, which is what we expect at RBA, then it actually is quite bullish from an equity market perspective, but you have to know where to invest within equities. Quite bearish for credit, if you ask me.
All right, Michael, we're going to have you back on soon to dive into that comment more. We could have spent another hour on that. Michael, thank you so much for joining us this morning. Really appreciate it. That was Michael Contopoulos. He is the Director of Fixed Income at Richard Bernstein Advisors.